All right. Welcome to a special episode of Shut the Fud Up. So sorry about the delay. Apparently, YouTube was just like, hey, yeah, we don't think that we need to recognize your camera because, yeah, we see you have one, but we, don't want to recognize it because we just like being a pain in the butt. But here is the sting for today here. The U.S. national debt, the federal national debt, is going to go to $100 trillion in about 5 to 6 years. And while that sucks, we don't really like that. That is going to be very good for your crypto bags. If you're invested in Hex, Pulse Chain, if you're invested in any of the what I call penny coins. So that is the subject of today. But I also got to point something out here. Apparently, mainstream crypto media is just now noticing that, hey, this cycle is taking longer. And of course, what they think that means is that the cycle is broken, that it's all over, and nothing's going to happen like it used to. Again, showing their complete illiteracy. And a lot of people are using this as a way to fud their own bags here and everything. So I got something very special that I want to share with everybody here that likes to fud their own bags. I think this is going to be the theme song now for our show here for Shut the Fud Up. This is going to be our theme song. I hope you like it. Let's see, is this working? All right. So that will be the intro to this program from now on. Oh, no sound? Okay, I'm sorry. Hang on just a moment. I'll fix that. Let's try that again. Ghetto YouTube. Can they make anything easy to do here? Hey, about just click this thing and that gets that working? No, they can't do that. Try this. Hey man, just want to let you know that sometimes you gotta shut the fuck up. This current time is just one of those times you gotta shut the fuck up. Don't go saying I dance like a white guy, right? I dance very, very thoroughly, okay? Yes, I am a white guy. I do not dance like a white guy. Kent, you heard the sound that time, right? I hope you did. Anybody wants to be putting my dance skills up to the test right here? I will own that challenge inside out. All right. So that will be our theme going forward here on this program. Shut the Fud Up. Matter of fact, I like it so much here. Why don't we hear it again? Why don't we hear a little bit more of Shut the Hey man, just want to let you know that sometimes you gotta shut the fuck up. This current time is just one of those times you gotta shut the fuck up. Hey man, just want to let you know that sometimes you gotta shut the fuck up. All right. Pointed right directly at you guys, Execute and Jail Rat Crypto. You guys who just could not bring yourselves you just could not bring yourselves to get on a stream here with me and debate. No, you just can't do that, can you? Of course not. Of course you can't do that. You believe so hard in your convictions. You believe them. You're so right and everything. But heavens no. Heavens no. You just wouldn't come on a stream and defend your foolishness. Oh no, you can't be bothered to do that. All right, so here's the thing about all these bears out there. I have made multiple invites and offers to them all. Say, hey, get on a stream with me. Let's talk it out. And every single time they talk real tough, like, of course. But then a moment, I'm like, well, why don't you just get on a stream here with me and we can discuss this? Exactly what the sound they make. Oh, I just don't care. That's all you, bro. And you know what it is here? It's not that you don't care. It's that you couldn't stand up to me. You know I'm going to come at you with facts after facts after facts that you can't dispute, and you don't want to look stupid. You still look stupid, but you don't want to look stupid on a live stream. So I think I'm done with all these bears. There's a bear out there that wants to get on a stream and hash this out with me. Contact me at Reinvent Ideal on Twitter. But since like nobody has the Spaldings to do that, I think I'm done making the offer. Now, here's something that I do want to talk about today here. Where did I see this? I saw this on Crypto Coffee's latest thing here. And man, where'd it go? Okay, here it is. Yeah, it's in this window. Well, you know what we should do here? We should start by talking about the general market. As you can see, it's down today. Yeah. I want to give everybody in the chat, I want everybody in the chat here to make a little guess here as to why you think it's down. Somebody can tell me why. I mean, there is something that I have said a zillion times for what causes crypto to go up and what causes it to go down. I've said it a bazillion times here. Yeah, not so much the break cut. I mean, you're close there, Sunlight. You're thinking the right way, but there's something else. I'll give you a hint. The deal is there's a guy out there who says this one thing doesn't matter, and I say it does matter. I asked him if he would get on a live stream with me so we could hash it out, and he went, I don't care. Because he knows I'm right, and he doesn't want to look stupid. So you guys, can you guess here? I mean, this is why everything is down here today for the most part. I mean, there's a few things that are having a little bit of a pop, like Sonic's having a little bit of a pop. Still nothing to write home about. And some of the other assets on Sonic, like Shadow and Spooky Swap, are getting a little bit of a pop. Still nothing to write home about. Oh, yes, the Richard Hart assets had a very good week. And you can just feel the haters seething, which is something I want to talk about today here, is all the haters that are pretending this past week just didn't happen. Anybody know why? Oh, well, looky there, Kent. Yes, you got it. The dollar index. Yeah. You know, some people think that the dollar index doesn't matter. Oh, yes, it does matter. And today is absolute proof of that. Because where is it at today? Gee, let's have a peek here. Where is that dollar index at? Oh, my, look at this. Who'd have thought? It's now in the 100s. I mean, earlier, like last week, it was down in the high 90s. It was like 97, 98. Now it's in the 100s. And imagine that crypto is down. But some people still think that the dollar index doesn't matter. And here's how stupid they are. You mean to tell me that an asset that is priced in dollars has no relationship at all with the purchasing power of those dollars? How much of a are you? That's why that guy chickened out and doesn't want to get on a stream here with me. Because when I say that and when I show the charts, he's going to look like a complete imbecile. And he doesn't want that. He doesn't want that. Which, hey, I wouldn't want that either. But you know what I would want then in that case? I'll tell you what I would want to do. There's one thing I would really want to do if I had that position and then somebody challenged me on that position and it turns out that that position was, here's what I would want to do. That's what I would do. And I would. When it's indisputable that I'm wrong, that's what I do. Or I own up to it. This guy just ain't going to do that. So, go back to the metrics of the day here. Let's see. How's the Pulse Chain assets doing? You know, even on a day that's as bad as today is, this is impressive. This is very impressive for a bad day to be only down 1% on the L1, only down 5% on the exchange, and even Hex. We had a whale sell out of Hex today. We're only down 7%. So still up on the weekly, still up on the monthly, still up on the quarter, and of course, still up from the all time lows. This is very impressive, guys. Very impressive. And this thing hasn't even done a fraction of what it's capable of. It has so much more runway ahead of it. It's going to be doing so much better than what you see here. So, this, you should be thoroughly encouraged by it. Over in the headlines, we really don't have anything great happening here in the headlines. The only thing I saw that stood out to me here was this one story about the Fed. Market sees dwindling odds of September interest rate cut from the Fed. Yeah, this is very unfortunate because when we go on over here to the CME, where they're placing bets on whether the Fed's going to cut rates or not, what I see here is, yeah, it looks like now they're thinking they're not going to cut rates. It used to be the opposite. It used to be like 60% of them thought that the Fed would cut in September. Now that's down to 40%. Only 4% think it's going to cut. And it's a very good chance that they're going to hold. It's a very good chance we're not going to get another rate cut until Jerome Powell leaves, which is next year. And so that's why I'm starting to say now, hey, guys, this run that we have, the real bull run, it might not actually get going until next year. Might not happen until next year. The only thing that can really make it happen is if the quantitative tightening stops, the quantitative easing begins, the money printing begins. There's going to be a lot of money printing coming here. We're going to talk about why that is here today. But this is what I wanted to start with today here. I saw this on Crypto Coffee's last stream. And here's what it says. Like, we got this article from mainstream crypto media here that says Bitcoin's 4-year cycle theory is dead. Which I would say here that, like, hey, there ain't no 4-year cycle. There's just the cycle, because crypto correlates and corresponds and follows the debt cycle. And with that debt cycle, it also follows quantitative easing. Because when the debt cycle cycles through and it all gets rolled over, they have to do quantitative easing because nobody wants to buy all those treasury bonds that they're issuing out. But apparently they don't know that over here at Defiant or at Bitwise, which surprises me here. Like, you guys are supposed to have your brains. You guys are supposed to have your heads out of your butts over there at Bitwise. And also Crypto Quant. He apparently doesn't know that. I mean, I fully understand that Ivan on tech doesn't know that, with how often during the bear market he was constantly like, Pelicans, why is your coin down? Oh yes, oh yes. Oh yes, oh yes, oh yes, we are hitting the button. Pelicans, hexagons, why is your coin down? Ivan, why do you have a hard time understanding why a gate-kept asset was not blasting off in the bear market? What part of that confuses you? But of course, he will never address that, ever. But hey, for once in his life, or for once in many years, he's finally said something good about the Pulse Chain ecosystem. That he's still at the top of my shit list, if you ask me. Also, Rand Nooner, you don't hear him talk about any of this here. He's still just like, oh my God, we got to invest here, we got to invest there, and 4-year cycle this, 4-year, and wherever we are on the calendar is going to determine where the price of crypto is going to be. And the people that should know this stuff, but they don't. I mean, how long have you been in crypto, bro? Randy Hipper, you're a very nice lady here. You should know this stuff. I think you do, but I never hear you talk about it. Scott Melker, another one you should know, but I don't hear you talk about it. Wendy O, I'm pretty sure you should know that crypto corresponds with the debt cycle, but I never hear you talk about it. Why is that? So let's see what the illiterates here have to say. It says Bitcoin's widely referenced 4-year cycle, which again, there is no 4-year cycle. There's just the cycle. The idea that its price predictably rises after each halving, oh my god, it has nothing to do with the halving, before crashing and recovering, might be losing relevance. It never had any relevance, according to separate analyses from CryptoQuant and Bitwise executives. In an X post, July 25th, Qi Young-ju declared that the Bitcoin cycle theory is dead. No, the cycle still goes on. It's just taking longer. Zhu argued that in previous market cycles, large holders typically offloaded their Bitcoin to retail investors at near price peaks. You think that's what caused the bear markets? No. This past one was caused by interest rates being increased. There's a correlation to it. Oh, also the dollar index, the DXY, as that started going up, Bitcoin started going down. It's perfect correlation. So what's dummy here got to say? So this time, old whales are going to sell to new long-term whales. Institutional adoption is bigger than we thought. Trading feels pointless. It was always pointless, you fool. Holders now outnumber traders. Okay. The shift, in his view, undermines traditional trading strategy. It wasn't a trading strategy, you big dumb jerk. You illiterate fool. Around cyclical retail behavior. My mistake, well, you've made mistakes all right. My mistake was ignoring this shift in my bull cycle is over call. Oh, okay, so this dummy earlier this year apparently had declared that the bull market was all over. And because he's saying this now basically to save face because it's very clear that he was wrong about that. He seriously thought that maybe a few months ago the bull market was all over. I sincerely apologize if my prediction impacted your investment. Guys, don't let this dude's predictions impact your investment because this dude clearly has no clue just what he's talking about. Still, the market hasn't forgotten Zhu's previous claims. In early April, when Bitcoin was trading around $84,000, he warned that the bull run was likely over. Why are we listening to this guy again? Not only has he been wrong before and dead wrong, but on top of that, he clearly doesn't understand what it is that causes crypto to go up in the increments that it goes up. He doesn't understand why it goes up every 4 years or roughly every 4 years. He doesn't understand that it correlates to the debt cycle. He doesn't understand that it all has to do with the strength of the dollar, that it's all about money printing. My God, Max Kaiser understands that. Max Kaiser, he's not all up there. Oh, here we go with some more idiocy here. Halving's impact. The CryptoQuant CEO is not alone in questioning the model. Other longtime market watchers have begun expressing similar skepticism about the durability of Bitcoin's 4-year cycle. Matt Hougan? Hougan? It's not Hogan. Matt Hougan, chief investment officer at Bitwise, has noted that the forces that have created prior 4-year cycles are now weaker. Well, there's some truth to that. I mean, if you believe that it was the halving that would cause it, because with each halving that we have, it has less power as the bit rewards, the block rewards, as the block rewards get smaller. Like in one more halving, your block rewards aren't even going to be one whole Bitcoin. So yeah, there's some credence to that, but still, it was never the halving that caused the Bitcoin to go up. It was the money printing. So let's see. The halving's impact weakens with each iteration. Okay, that's true. Hougan argued in an X post today, while external pressures like interest rates and regulatory risk have softened. Well, interest rates still haven't softened. Meanwhile, bigger long-term forces are taking over, Hougan says. For instance, the steady flow of money into spot ETFs, growing interest from institutional investors, and Wall Street's slow move into building crypto infrastructure. All right, I want to say this here about that. All of that stuff in that paragraph, such as ETFs, institutional investors, that's the only reason crypto has gone up at all so far this cycle. That's all it is. That's the only reason it's gone up. There has not been any other reason that it's gone up, because what causes the real bull run still has not yet occurred. Man, I got to educate all of you people out there. Regulatory progress began in earnest in January 2025 and will run for multiple years. Okay, I'll give you that one. I mean, yeah, the regulatory progress helps. Wall Street is just now starting to build on crypto and will invest billions in the quarters and years to come. This started in earnest with the passage of the Genius Act this month. Oh, the Genius Act is going to really, really help us. Yes, I showed you that last week. The result, he suggested, may not be another explosive super cycle, but rather a sustained, steady boom. Oh my. Yep. We got another illiterate here. Yep, absolute illiterate. You're telling me that the United States government using stablecoin issuers as purchasing power for the treasuries, that's not going to get exploited by a federal government that doesn't want to reduce spending. That's not going to cram a whole bunch of new money into the ecosystem. All of these institutions and everything, and just the reflexivity of the asset, that's not going to create a parabolic blast off of FOMO that happens all within like 1 month. My God. You see, here's the thing about like these cycles is that when they happen, at first everybody tries to deny that they're even happening. And they all just want to be like, but then when they finally do happen and finish, then all of a sudden they go, oh man, I can't believe I didn't know that it was going to cycle through just like it did time. They find out, they find out, like, or they know, but they think they know better the second time around. Oh, man. And then they're going to be all embarrassed by it. All right. Table Rus. When T-bills, technically the T-bills are coming out right now. Like there's a matter of fact, you want to take a look at that? Let's take a look at that. Technically they're coming out right now. They're spewing out a lot of T-bills. But let's have a look here at the Treasury market. See, the thing that's really kind of holding things up right now is the deal between the Department of Defense and MP Materials. Okay, so 10-year Treasury is at 4.37%. And let's see, it's not going to let me look at this here, is it? Well, hang on. Let me log into it. See, they need the deal from the DoD to the company MP Materials to go through so that MP Materials can start building a factory, a refinery, and all of the different infrastructure they need to be able to process the rare earths here. That is going to take us a little bit of time. Hang on a second. I got to log in is what it is. All right. Logged in here. Now, let me be back to sharing the screen. Because it takes a long time here to build a factory. Takes a long to do that. All right, so what we wanted to show you was the new issues here for the treasuries. We can see right now that there are, what do we got here? Okay, here is a T-bill. Here is another T-bill. See, this one is also a T-bill. Yeah, a whole bunch of them. The first note is going to be this one right here. So we got 4 T-bills. 4 T-bills in issuance here. And each one of them has got an expected yield over 4%. And that tells me, like, when you have a very high yield like that, 4% is a very high yield for a treasury. When you have a high yield like that, that means there is a huge supply of these. There's a huge supply. There's not enough people to buy them. So they are issuing the T-bills here and everything. But what's going to need to happen here is that the stablecoin companies, the stablecoin issuers, they're going to be moving in to come buy all of these. And that's going to bring more money into the ecosystem. That's what I was talking about last week. All right, so what did we learn here just now today? The mainstream crypto media still does not get it. All right, they still don't realize that the crypto cycle corresponds with the debt cycle because the debt cycle causes money printing by the Fed, and the money printing weakens the DXY. And since crypto is priced in dollars, it causes crypto to go up. And money printing is coming. It is going to happen. It hasn't started yet, which is why the bull run hasn't started yet. But how do I know money printing is coming? Well, what's my current assessment of America's fiscal situation? If I had to give it one word, here's the word: unsustainable. If I had to give it two words, here's the two words: completely unsustainable. I mean, imagine trying to run a marathon while you're carrying a fridge, but the fridge is full of IOUs on your back and it's on fire. That's where we are. And it gets better. It gets better here. Because see, here's what I want to talk about today here. Here's like the big subject that we're going to focus on is that the U.S. national debt is heading towards $100 trillion, and it might get there a lot faster than you think. Like faster than you could say economic dumpster fire. All right? And of course, everybody out there is going to be like, well, $100 trillion. Oh my God, man, wouldn't that destroy the country there? Wouldn't that wreck the world? You would think. But I'm going to show you how that's possible. And then what I'm going to do is I'm going to show you why that's bullish for your bags. I mean, I think you already know why. Like, if they issue out $100 trillion worth of debt with over the next few years, somebody's going to have to buy it. Retail investors don't want to buy it. And the rest of the world really doesn't want to buy it. Somebody's going to have to. Usually it's going to be central banks or it's going to be another culprit. We'll get to that one today here. I'm going to show you exactly how it works here. Like, exactly where does all this new money come from? Because we need new money in our space. We need new money in the ecosystem. Where is it going to come from? Because right now, the average person in America doesn't have no money. They don't have anything to spend. We're actually in a recession. I didn't look at the GDP numbers yesterday. I'm going to look at them probably next week. But something you can tell right here is that, yeah, we're in a recession, or we're not doing as well as they would like you to believe. All right. So some people think that this current crypto cycle, well, some people think it's all over, but then some other people think that this one that we're experiencing is going to be the last one ever. And, for a while, I thought that too, because I'm just like, well, this cycle seems to be just way too predictable. And if there's any further movements in it in the future, it would certainly have to be less predictable just from the nature of it all here. But when it gets way too predictable and everybody kind of knows what's going to happen, well, that changes what's going to happen, right? Okay. It's true, but you see, we got to understand how the debt cycle is what's causing it. But does this mean that this will be the last crypto cycle ever? I don't think so. I think Bitcoin will have a harder time posting great returns for a couple of reasons. Like, one, the block reward is going to be less than one whole coin soon. But then two, that whole narrative about Bitcoin being rare, that's going to go away, or that's not going to matter, because what you have is a lot of these companies that are going to be storing their cash treasuries in Bitcoin. And they're publicly traded companies. But you see, if you're buying MicroStrategy today, you may as well just buy Bitcoin. It's kind of the same thing, because MicroStrategy's price moves and everything, all of it is related to the Bitcoin treasury that they have. None of it is related to how good of a business MicroStrategy is. Like, what MicroStrategy's cash flows are and everything, none of that matters in the stock's price. So when you have all these other companies that are going to be trying to mimic MicroStrategy and do the exact same thing, their stock is going to be moving up or down based on the price of Bitcoin. So buying their stock is going to be just like buying Bitcoin. And when you have all of these different companies issuing all this different stock, and it's an unlimited amount of stock that they can issue unless there's some restriction in the company charter, That means anybody can buy it. There's plenty of supply out there. So the fixed supply, the 21 million, that's not going to be a thing anymore. It's not going to be a positive with all those treasury companies. All right. And also, when you realize that the debt cycle and money printing is what causes these things to go up, then you realize that the national debt growing at the rate that it's growing, when you realize this year it's going to be about $100 trillion in 5 years, I think we can say there's at least one more crypto cycle left. I don't know what happens after that. But I do think that there's at least one more left here after this one. So let's start with a little bit of time travel. You want to go back to 1980. What was the national debt back in 1980? Anybody know? I mean, that's something that comes up at a party conversation a lot now, isn't it? Hey, you remember what the national debt was back in 1980? Oh, yes, I do remember. It was a almost adorable $900 billion. Oh, my God, you are so smart. Oh, yes, I am, absolutely. And hey, you are a cute girl. And since you think I'm smart, we should go upstairs and we should have sex, right? That's never what happens, but man, wouldn't that be funny? Something like out of a Family Guy cartoon. Is it when it comes to like all those parties and everything? I wish I'd known this here because I was like very envious of all the cool kids back in college that got to go to parties. Yeah, I didn't get to do that. I had to work. I did learn the hard way though, because I went to one of these stupid college parties once here and realized, oh my God, this is the dumbest thing ever. Because all you guys do is you just talk about the exact same materialist and popularity crap that y'all talk about everywhere else on campus. But now you're just doing it here with alcohol and you're playing Twister and the real self-absorbed kids are fluffing their own nuts. And then like the real pretty people are getting really drunk and hooking up and then hitting each other with false accusations afterwards. That's exactly what the college party scene was like. So if you never got to live that life there, don't worry, you're not missing out on anything. And if you are a kid right now that hasn't gone to college, don't go. I promise you, you're not missing out on anything and you will not regret not going. All right, where was I? Okay. $900 billion was the national debt back in 1980. That's billion with a B. Back when a billion felt like a lot of money. Back when, what else here was expensive back in 1980? Or not very expensive, but cheap. I mean, like movie budgets, it was considered a very high budget if it was $10 million or more. That's what life was like back in the 80s. It was good times. Now, fast forward to today. Right now, the national debt is 37 trillion. That's a trillion with a T. And that's a number that seems like so obscene, like it's auditioning for a Marvel movie budget. All right. That's a 40-fold increase over the 4 decades from 1980 to today. It's a 40x. And I'm standing here saying it's not just going to keep climbing. It's going to triple to about 100 trillion and possibly before we even think it will. Like at least within the next 10 years, I'm thinking 5 years. Now I can already hear you typing furiously in the chat there going, Cairo, 100 trillion. That's bonkers. It's 3 times what we're at now. We're all going to die. No. I mean, yeah, I know it's bonkers and everything, but you see, that's exactly the point. It's exactly the point. So we hit 100 trillion in about 7 years because tripling is just what it's done historically. All right, from about 1970 to 1980, the debt went from 370 billion to 900 billion. In fact, I think I even have a chart that shows this here. Y'all like my charts, right? I feel like Ross Perot every time I show them, and oh man, some of y'all that are old enough to remember Ross Perot and how annoying they all were. Let's see, is this one I got right here? Yeah, here we go. Everybody, check this out right here. This is the national debt, which kind of looks like a hockey stick going off right here, right? Really nasty looking chart. Really nasty looking chart here. And yeah, that's right, Kent. It is going exponential. Yeah. From 1970, it triples from 370 to about 900 billion. So there's a 3x. from 1980 to 1990, it goes from 900 billion to 3.3 trillion. That's a little bit more than a 3x. That's actually closer to a 4x. So when I say we're going to hit 100 trillion in about 7 years, I'm not just pulling those numbers out my ass. What I'm doing is I'm looking at the past and going, well, we've done this before. So why not do it again? Why not faster? Because the deficits here in this country are ballooning like a bad sitcom that keeps getting renewed. Yeah, there is a little bit more spice to all of this here. Like, how does this debt even get bought? Who's got the cash for an additional $60 trillion in more treasuries? We don't even have enough people buying the 37 trillion of treasuries that exist right now. You don't have the money. I don't have the money. Unless your piggy bank has been moonlighting as a hedge fund or a stripper. The bond market is not a charity shop. All right. They issue out all of these treasuries here and everything. Nobody's queuing up to buy $600 trillion of IOUs unless it's at a good price. And remember, with treasuries, or really with bonds in general, with any of this here, when we say it got to be at a good price, what we're really talking about there is the yields, which, going back to this screen here, this is what we're talking about. 4.37%. And I noticed something here is like even these yields that you see here, the market is currently telling you that they don't even think these are good yields. Because if these were good yields, they would get bought up and come down. Because remember, you got an inverse relationship between the price of the bond and the yield that it produces. So as the price goes up with each purchase order, that yield would come down. What the Treasury market is telling you is that the bond market doesn't really think these are all that great here, because if they were, they would be buying them up and pushing those yields down. That's not currently happening now, is it? What do you think is going to be the effect here when we got a lot more treasuries out there? We got a lot more being issued because the debt just keeps going up and up exponentially. All right. And I promise you, I will tell you how this all relates to crypto. But what I want to get across here is that if the U.S. floods the market with that much debt, well, then all of the bond investors, they're going to smell blood. They're going to dump their treasuries faster than you can unfollow an X on social media. And the long end of the curve, what I mean by that is the 10-year treasury yield, that's going to blow up. The rates are going to spike. And that's not good for the country. Because when that happens, when the 10-year goes up, that means the federal government is going to have a really hard time borrowing money to finance its operations, especially if it's got like a 7% interest rate. What do they do to stop that? Historically, what they do is they go talk to the Federal Reserve and ask them to wade in like a tired lifeguard and buy up all the debt, doing what they call yield curve control, and buying up all of the long-term treasuries to push the yields down. That's like the release valve. And that also has an impact on the dollar itself. Because where's the Fed get the money to buy up all those treasuries? They print those dollar bills. So that's new money added to circulation. That new money added to circulation is what's causing your crypto coins to go up in price. Because the more money that they print, the more money they add to circulation, that money has to have some place to go. And where it goes, how it's accounted for in the system, is in financial assets like crypto. Crypto has the most powerful, reflexive bonanza effect on it just because it's so small. All right. So, haven't we heard this doom loop before? Yes, you have. It's the same tune that has been played ever since the 1980s. Just this time, the numbers are a lot bigger. Well, let's pause here and look at the numbers in our way, because you see charts, well, charts can lie like a politician does. Like, this looks terrible here. It's like, oh my gosh, it's going to be like a straight hockey stick chart. But let me put it into terms everybody will understand here. When everybody looks at the hex charts, everybody goes, oh, we're down 99%. We're down 99% from the top. And everyone thinks that, like, that means the coin is doomed. One douchebag on X, either today or yesterday, tried doing that to me here when I was doing my little victory lap. It posts a chart of the EHEX price that just looks like this. It goes, zzz, zzz. And it looks like it all just went up and then down and died. That's what it looks like, the EHEX chart. What is it that we tell all those people to do when they're looking at a price chart? Well, there's a little thing that we all tell them to click, right? Yeah. Click where it says log, so that you're looking at an honest chart that tells you what's really going on, because that shows you the gains and losses in percentages. Well, what if we were able to click log on this chart here? How does that look? Well, what do you know? We are, but oh, wait a minute. I didn't log here. Okay, I think I got to go over here to edit graph and formats, log. There we go. All right. So that's what happens when you click log. This doesn't look so hockey sticky now, does it? No, this looks like a pretty steady climb, right? Don't look anywhere near as nuts as the previous one. And there's a reason why we want to look at these things right here, because this tells us, the percent year over year growth in terms of percentage. And yeah, it's really not that bad. So to think that, like, we go from $100 trillion and that's the end of the country because, that's just debt that we can never pay back. When we look at it from this chart right here, we realize, well, still a pretty steady, consistent climb right here. So it's not going to be the end of the world. All right. Last chart looked like a hockey stick on steroids, straight up to 37 trillion. But when we look at it here like this, it's more of a meh, not that bad. It's like since 2010, the debt's growth rate has actually slowed down compared to the 70s and the 80s, believe it or not. You see, back then, they were tripling and quadrupling the debt. Now it's more like, instead of a competitive sport, now it's more like a leisurely jog. Instead of a sprint, it's just a. All right. So when people in the sound money crowd, when they start clutching their pearls or clutching their gold bars and scream, $100 trillion! It's madness! We can say, calm down, Janet. We've done crazier in the past. Now, since $100 trillion is a number that kind of makes your eyes water, and it still sounds pretty bad, and that's going to have Peter Schiff preaching all about gold and everything, about how that's the only real money that we should be buying into. It's still going to scare people, because we got to ask ourselves, well, how does the market actually absorb all of this new debt, all the new treasuries and everything? That is where it gets properly mind-bending. You'd think that there's not enough money in the world to buy that much debt, right? And you know what? If that was your thought, you're actually right. There is not enough money in the world to buy all the debt sometimes. Because take a look over here at this. Something I pulled up from Statista. This tells us the gross domestic product across the entire globe. And it goes all the way back to the 80s. So I got to go back to 1985 here is the furthest, or 1986 is the farthest back I can go. Or no, I can go 85. $12.5 trillion was the global GDP in 1985. You know what I like about 1985? It's a really good Godzilla movie that came out that year. And it was actually called Godzilla 1985. Probably my favorite Godzilla movie, actually, until -1 came out. All right. So back in 1985, global GDP was $12 trillion, and the U.S. debt was $1.7 trillion. Now, let's fast forward to the year 2007. just before the financial crisis. So right where here? Yeah, right here. Well, 2008, just before the financial crisis. $64 trillion was global GDP. 64 trillion. All right. Why do I bring that up? Why is that important? I'll tell you exactly why. Because with US debt, where was that at? We go back to this chart here. 2008 or 7, 9.5 trillion. All right. So there's $64 trillion in the world, and then a US debt pushing 10 trillion. But where did that 64 trillion come from? Because it was kind of steady right here, but man, about right here, 2002, it doubled. The global GDP doubled. How the heck did that happen? How does that happen there? All right. How do you go from a world with maybe 9 trillion in circulating dollar bills to one that absorbs 9 trillion in treasuries without blinking, without stopping to catch a breath? I mean, did the Fed just print it all? That's what a lot of people are going to think here. The Federal Reserve printed all that money, right? No. Believe it or not, no. And this is what I really want to show you today here. Because, like, one of the streams that did, I think it was back at the PulseX conference, that said the Fed is going to print a whole bunch of money to buy treasuries. They will do that, but they don't even have to. It doesn't even have to be the Fed that does it. Like, somebody's going to do it, but it could be the Fed, but it doesn't even have to be. Because check this chart out here. What this chart here shows is the Fed's balance sheet. What we mean by like the Fed's balance sheet is when they buy a treasury, it goes on their balance sheet. And as they buy treasuries, the balance sheet goes up. We go back to 2008. They only had about 45. Only had about 45. Is this in trillions here? I think this is in. Oh no, yeah. This is in trillions. They had 45 trillion in their balance sheet. No, I'm sorry, this is billion. They had only 45 billion on their balance sheet. Then they went up to about almost 900 billion on their balance sheet. What's going on here? What's going on? Yeah, it's not the Fed. You see, the Fed's balance sheet, it barely budged here. We had 41 billion in reserves starting in 1985. And then all the way up until 2008, they were still at 45 trillion. So we start 1985, just at 45 or 42, 41. Okay. And then all the way up to just before the financial crisis, we're at 45. It's a very slow, steady climb up to that up to that dollar amount. So where did all this money come from? All right. Here's the dirty secret. It's not the Fed, but it's all the other banks. All right. Not some treasury wizard minting a $10 trillion coin. The banking system, your regular bank, your JP Morgan, your Bank of America, your Citibank, they all create money out of thin air, not just through lending, but also through buying assets like treasuries. It's like they got a magic photocopier that prints dollars. Whenever someone needs to buy Uncle Sam's debt, they fire up the copier, print the money, and buy the debts. And that's why for the last 75 years, the supply of treasuries hasn't really mattered in terms of affecting the price, or not the price, affecting the yield. Yeah. What affects the treasury yields is, you say, well, it's supply and demand because it determines the price of the bond, and the price of the bond determines the yield. Yeah. And the supply has grown. So you would think that with the supply growing and the demand staying the same, those yields should be going up. But it's not always been the case. In fact, they haven't really gotten that too crazy. I mean, see, I got a chart here that shows that. Yeah, I do. This one right here. This is the. Let's look at the all-time chart here. All right. There was one period of time where it got real crazy back in the 80s. Here was over 15%. But really, ever since 2000, it's kind of stayed within this range here of 5% or less. 5% or less is where it stayed. Even all throughout the 90s, it was roughly around there too. Even though the supply just kept growing and growing and growing, even though the supply was growing, notice this here, the yield on those treasuries kept going down. How is that possible? You keep increasing the supply of things to buy, but not increasing the supply of the buyers, not increasing the demand, and still the price is going up. How in the holy hell is that possible? I'll tell you exactly how it's possible right here. Is that the banks, not just the Federal Reserve, but the banks also print money like the Federal Reserve does. The reason the bond market hasn't collapsed under the weight of all of these treasuries being issued, and despite all of this crazy debt and everybody saying that it's unsustainable, despite Peter Schiff being out there saying you need to buy gold because the treasury could fail. I don't know if he actually says that, but that's kind of the gist of like what every gold bug has ever told me. It's always been about growth expectations and inflation expectations that is determining the yield on a treasury. We could call it nominal GDP. You want to sound clever at a party? Just say nominal GDP. Oh, you're a very smart man there. You say nominal GDP. Yes, as a matter of fact, I do. Oh, my, man, I wish I was as smart as you. So the world's economy grows, and as it grows, well, all the banks across the world create more money, and somehow there's always enough of it to soak up the debt. It's a limitless capacity. Think of it as like an all-you-can-eat buffet for bonds. Now, I'm not saying this is going to continue to go on and on forever. I'm not saying we won't wake up one day to find that the dollar's been demoted to wallpaper. That could happen. But when I say $100 trillion in 7 years, what I'm saying here is that deficits keep ballooning and the banks keep printing their own money to cover all the new treasuries that are creating those deficits. And we could get there a lot faster than you can say quantitative easing. All right, so what happens then? Interest rates, the dollar, the Fed's balance sheet, they all go up in the air like a clown juggling flaming torches. And that's where the real fun starts. All right. So, how does this relate to crypto? You could be a Bitcoiner. You could be an Ethereum. You could be an Ethereum fool. You could be somebody into Solandra, or you could be in the Richard Hart assets. You'd be hoarding all of these like it's the apocalypse coming. And nobody can deny the cold hard fact that the market for U.S. Treasuries so far has been a bottomless pit. That's causing more dollar bills to be printed because, you see, when new treasuries are being issued, that gives these banks an excuse to print money, which they want to do, and that money added to circulation in the economy has to be accounted for by assets in the economy. We're not making more houses, we're not making more cars, or at least not making enough of them to account for all the new money that's going to come in. So where's that money going to go? It's going to go into financial assets. What is the most reactive? What is the most reflexive? What is the least liquid? And what is the smallest financial asset that has the most powerful overreactions to additions of new money into circulation in the economy? Crypto. Hey, what crypto asset has the lowest liquidity? Hex, right? Yeah, and Pulse Chain and Pulse X and the incentive token. That's right. They got the lowest liquidity of them all. And hey, isn't there like one of those that as you buy it, it gets more rare? Yeah, then they have like a conference recently. Man, I forget what it was called, man. Pulse X! That's right, Pulse X. Okay. All right, so they're advancing. They're all of these treasuries here as they're being issued out here and everything. What's being factored into the price is growth and inflation expectations, and that sounds like it's just some It sounds like it's just some fancy stuff right there, but really don't think of it as anything fancy because all it is it's just the bankers are thinking, well, if the economy is going to be growing at this rate right here, we want to basically lock in this particular gain because if the economy is going to grow at this rate, that means inflation is going to be just a little bit less than that. All right. So what I'm trying to show you here is like the system is basically rigged against you and me, and crypto is our only way to kind of fight back over it. And I'll show you how here. Like when I read this, it made perfect sense, but this might take people a little bit of a while here. This is from Bank of England, and what they show you here is exactly how a bank prints money out of thin air, and specifically how they do it when they buy new assets like a treasury. And they show you how it works here if it's a central bank or if it's a commercial bank. Basically, like any new loan that they buy right here that they give out, that's new money printed on the spot. So if you took out a mortgage, to buy a house, the money that you're borrowing is not from the bank's vault. That's money that is created right there on the spot. And it's not that the bank has a printing press downstairs or anything. It's just this money that's added to the computer. All right. And the more deposits that are in the bank, the more money that they're able to create out of thin air. And then pass that money out and basically get it circulating to the economy and inflate the economy. All right. So that's what that paper shows us. Yeah. Picture a commercial bank. It's got a balance sheet that's all neat and tidy. It's got the assets on one side and liabilities on the other. Matter of fact, let me pull that slide back up here so you can visualize it. All right. So this here, the commercial bank, we got the assets over on this side. We got the liabilities on this side. All right. We got our reserves, our currency deposits, the usual suspects. Let's say that this bank decides to make a loan, like a mortgage for some poor soul trying to buy a house in the economy. And what happens is they don't rummage through the vaults like Scrooge McDuck. What they do is they create new money out of thin air. Poof, poof. And when new deposits come in, well, those new deposits are a liability to the bank because that's money that they owe back to the depositor. To balance it out, they create new money that goes in figuratively in their vault as an asset that balances it out. All right. So the deposits, they didn't exist before. The assets didn't exist before. But when a deposit comes in, now the bank can create money out of thin air to put on the asset side of the balance sheet to balance it out. All right. Bank conjures it up like pulling a rabbit out of a hat, except the rabbit's made of debt and nobody's clapping. All right. These deposits, and they're money, not base money. See, nobody's hauling gold bars to Chipotle, but you can swipe your debit card for a burrito at Chipotle and it works just fine. Because in the real world, nobody cares if it's real dollars or if it's bank created dollar credit. See, it's all fungible, just like swapping one bad decision for another. So these dollars, they circulate. That allows you to buy a house. It allows you to buy assets. More importantly, it will allow you to buy treasuries. That's the bit that most of these banks get. See, when banks lend, money appears and life goes on. But the same when banks buy assets and they buy treasuries, they're creating money on the spot to buy those treasuries. All right, so think of it like this here. Like we got a consumer, some regular Joe, not a bank, but just a regular person. They own a treasury. And they bank with, say, JP Morgan Chase. And JP Morgan, they like treasuries too. They want to invest in some. Now, does JP Morgan dip into their bank account and hand over cash? No. Instead, they do the same thing, the same trick here. They credit the consumer's account with new deposits, and then the treasury becomes the asset on their balance sheet. It's not a loan this time. It's a treasury. It's the same deal. The bank's balance sheet grows, and new money is born, ready to buy more debt, or it could buy a yacht or whatever the bank dreams about. Right? Now, Might be wondering, why do they do that? What's the point there? There's a reason why. See, when you deposit money into a bank, the bank owes you interest. Where do they get that interest? From treasuries. That's why. They pay you less than they get paid from those treasuries, and they pocket the difference. Yeah. So if there's $9 trillion in new treasuries, they can just whip up $9 trillion in new deposits to buy them. Unlimited capacity is like an all-you-can-eat buffet for bonds. Now, if Scott Bessent dumped $9 trillion on the market tomorrow, that's going to cause some trouble. But if you spread it over a couple of years, well, the banks will just churn out more money, and everything keeps going, keeps chugging along, and the market just yawns. But why would the banks do this here? Why would they keep buying treasuries when yields can go down, or they can go up, or they can bite them in the butt? Take a look here at the 10-year treasury yield here again. This chart, the history of the yields. Why keep buying treasuries when the yields can go around like this? Well, picture that you're a bank, and it's 2020, and you've got a treasury that's yielding a measly 0.5%, 0.5%. Right? And then fast forward to today, where yields are at 4.5%, your treasury value has tanked. It's down 30 to 40% maybe. And you're sitting there bleeding value. And I'm over here banging about limitless demand. You'd be forgiven if you think I lost it. All right? You'd be like, Cairo, why would banks keep buying these things if they're just going to get clobbered? It's a very fair question. But here's the dirty secret. See, the banks aren't like you and me, where we got to clutch our portfolios and cry over paper losses. If you buy a treasury at 0.5% and you hold it for 10 years, you're getting your principal back. Now, sure, there's inflation that's eating it alive. 5% inflation against a 0.5% yield. That sucks. For you, that'd be a disaster. But for the banks, it's just a Tuesday. So they don't sweat these mark-to-market losses like we do because their game is different. They're the backbone of the entire money system in the world. They get to create money to soak up the treasuries because that's how the system stays afloat. All right. Now we look at the Fed's balance sheet here again. Let me show you this here. Where did I have that? I think I had it here. Okay, yeah. Notice like it was pretty flat for a good 45 years. And then it starts spiking up and going out of control, going crazy here and everything. Like as they were just starting to bring it down, COVID disaster happens and they kick it right back up. And then notice over here, November 2021 was the peak. What else happened in November 2021? Anyone want to take a guess? Anyone remember what was going on then in November 2021? I'm sure y'all remember it, right? I mean, wasn't there like something that had us all euphoric and had us all jumping for joy? Be like, oh, life is so great. Yeah, that was the Bitcoin top where it hit $69,000. There's correlation here on the Fed's balance sheet and the Bitcoin price. When they bought up all those treasuries and the Fed's balance sheet hit the top, Bitcoin hit the top. And then as they started selling off those treasuries, reducing their balance sheet, Bitcoin went down. This is why I can't get any bears to debate me. Because when I point stuff out like this here, it's indisputable that I'm right. And they don't want to look stupid because they will look stupid. Looky here, though. How far did we go down? We didn't really go down that far. We went down, but not that far. And then we kind of picked it back up a little bit, and then we stopped picking back up. So we're about halfway down from the top there, from where we were before. A little bit more than halfway. What do you think happens to Bitcoin when it starts going back up and the Fed's balance sheet starts growing again? What do you think happens when the Fed's balance sheet goes past where it was? And then what do you think happens to the crypto market? Anybody want to challenge me on this? Of course not. So you guys know you will lose if you try to challenge me on it. All right. So why don't yields go crazy though if the supply is endless? Because one, the Fed can buy up a bunch of those treasuries, take them off the market, bring the yields back down. And then two, regular banks and commercial banks can do the exact same thing. All right. They can keep on doing it. And when banks buy treasuries, they're not dipping into their own money, they're creating new money. All right. So as you see a deposit at the bank, that's a liability on the bank's balance sheet. But when they buy a treasury, that treasury is an asset. They pay 1% on a savings account, but then they earn 4% on a treasury. They get a 3% spread. And to them, that's free money. That's free money for them. And if you were getting free money, you'd take it, right? Right. And some of you might be thinking, well, hang on, Cairo. What about Silicon Valley Bank? Didn't they get obliterated holding treasuries when the rates spike? Yeah, that's right. They did. And that's a risk that these banks face. If a bank buys treasuries and then the rates shoot up and deposit flight hits, well, now they're going to be forced to sell at a loss and their balance sheet is going to look like it just got kicked in the balls. That's why banks don't do this all the time. That's why they don't just buy everything. Because if they can print their own money, like, well, if they print their own money, why don't they just go buy every stock and every crypto and every gold bar and every overpriced dump in New York? If banks can create unlimited money, why don't they just buy the whole world? Because every time they create money, they're also creating a liability. And it's not like you or me with a basement money printer. They're churning out perfect $100 bills with no consequence. I mean, if I was able to do that, you know what I'd be doing? I'd be buying sushi for breakfast, lunch, and dinner and retiring on a cruise ship all to myself. But you see, the banks, they've got to have an offsetting liability for every dollar that they create. So they have to be picky. And why do they like the treasuries? Because the treasury is a guaranteed investment that's not going to go into default. All right. If a bank could print money to buy anything, or if you ran a bank and you could print money to buy anything, would you snap up a Lamborghini? If you're stupid, you would, but if you're smart, no, because the Lambo will depreciate faster than Rachel Zegler's career. And it's going to leave you with negative equity, a one-way ticket to bankruptcy. But a treasury, if you hold it to maturity, you will get your principal back. And inflation might nibble away at the value, but the banks don't care about that. Because you see, their assets, their liabilities are both in dollars. So if the dollar tanks, it's a wash. They're still pocketing that sweet spread where the treasuries earn them 4%. They only got to pay 1% of it out to the depositors. All right. Now, if the economy is booming and lending to, say, a startup or a property developer, and they determine that they could net a greater percent return on that lending than on the treasury, well, they'll take the riskier bet. Because the higher the risk, supposedly the higher reward. But if the economy is wobbling, the risk is a lot higher, so they stick to treasuries. Showed you the chart before about the GDP in each state. The economy is wobbling. Everybody likes to say, oh, the economy's great. It's not great right now, guys. That's why nobody has money for anything. It is wobbling. Now, talking about the interest rates here. The banks, they think in terms of nominal GDP. That's growth plus inflation. And it's going to chug along at, say, 4.5%, like that's their benchmark. So suppose Scott Bessent floods the market with treasuries or tariffs spark an inflation scare, and then the 10-year treasury yield spikes up to 5.5%. Well, the banks are going to see that as a bargain. They'll be like, hey, 5.5% is cheap compared to 4.5 growth expectations. So they'll buy, create new money to do it, and over 6 months to a year, those yields will drift back to 4.5%. And then 6 months to a year, all that new money they created gets absorbed by the larger economy and has to go where? Into financial assets. Yep. Now, last week, I showed you that there's a new bond buying bank in town, the Stablecoins. All right. The Genius Act was basically a way to mandate that stablecoin issuers become the new Treasury bill buyers and give the government an extra 10 trillion line of credit. And that's why this bull run is going to be bigger than any previous one. stablecoins or some other madness hoover up the treasuries and buy them all up, or the Feds starts doing QE and the yields drop to 3.5. I mean, just going from 4.5 to 3.5, it's trillions of dollars being created, guys. Trillions of dollars. What's going to happen then is the banks will sell because a 3.5% yield is too low when they have expectations on growth of 4.5%. So they'll dump treasuries and then use the balance sheet for something juicier. The yields will creep back up. So it's like the market's got this invisible thermostat. It's always nudging rates towards their nominal GDP expectations. Right? This is the most misunderstood thing in macroeconomics. See, I don't care if you're a Keynesian or if you're an Austrian or if you're a hedge fund guru or if you're some cringe influencer with a fancy avatar. Nobody seems to get this, just like how nobody seems to get the whole crypto cycle and what causes it. In 1985, there literally wasn't enough money on Earth to absorb the treasuries that were going to be issued over the next 2 decades. Let's take a look at that chart here again. Where is that? Yeah, here it is. Wasn't enough money here to absorb it all. All right, because let's have a look here at the year 2014. $79 trillion global GDP. What was the national debt here in 2014? It was, I'm ahead of myself here. 17,000. So there was enough money here then. But what about before? Really, we didn't get to that until, it would take all the money in the world from the year 1986 to buy up the national debt just for the United States. We look at like all the money in the world in 2020, 85 trillion. I think 2020 was when we hit $30 trillion. Well, close to it. Pretty close. 26 trillion, right? Oh, no. We almost, still was pretty close. 27 trillion. Right? So you're going to tell me that almost half of all the money in the world decided to go into treasuries? No. What happens first is the banks create that money first, and then the United States government issues the treasuries, taking out the debt, and then the banks buy it up. And this is kind of like quantitative easing. It's money printing. It's adding more dollar bills to circulation. This is what causes crypto to go up. If the person that you're listening to, if you're an influencer, if you're a streamer, does not get this, then I wouldn't listen to them. I mean, it's such a basic thing right here. This is what causes bull runs, and this is what causes bear runs too. When the bear market happens, is that they stop printing the money, and the Fed starts selling the treasuries. The bank starts selling the treasuries too. This is what causes bull runs. This is what causes bear markets. If the person that you're listening to, your streamers, your cringe influencers, they don't know this, stop following them and block them. They're not literate. God, man, like all the people that were saying, the bull run's over, old season's canceled. They didn't know this. So they're illiterate. Stop listening to illiterates. I don't know how many times I got to bring this up right here. All right? So, the debt's been sustainable because banks can create near limitless money to buy it, and they're happy to. Because that spread is their happy place. Are there supply concerns? It's never really mattered in the long term. However much debt they issue, it's not had an effect on the yield. It's all about growth and inflation expectations. People don't understand this, but you see, that's actually a good thing for you, the hex holder. Because when people think that the U.S. will default on its debt because the debt is just too high, and when people think that the Treasury will fail, what do? They buy things such as gold. Yeah, I mean, listen to Peter Schiff, and he tells them, go buy gold. Maybe some industrial metals too, like copper. But wait a minute, isn't there something else that was invented around like 2008, 2009 that it was meant to be like an alternative form of money, and people believe that it has a fixed supply and everything, and you could use it for like some peer-to-peer payment system and everything. Yeah, what was that thing called? Does anybody know here? Man, we gotta really figure it out. Oh yes, cryptocurrency. That is viewed by the general illiterate investing public as an alternative to US dollars. And people buy it when they think the Treasury is going to fail. And you people, you hex holders, are in the best position right now because you have the lowest liquidity. You have all the gatekeeping, which is a bad thing. But when the gatekeeping comes down, that's going to have monumental impacts on the price, monumental positive impact, I might add. And the more people buy it, it's like Uber. Is it with Uber? The more people they have in the network, the stronger the network becomes. And like the stronger Uber became, as more people started using it, the stock kept going up. Because as the network grows, it gets stronger and kicks out competitors. Usually it's the opposite. Like when a company is getting stronger and stronger and bringing in lots and lots of money and customers and users, well, then competitors want to step in. But the thing with Uber is that as the network was growing and everybody was using Uber, you were more likely to get a ride when you wanted one with Uber. And it was very hard for a new competitor like Lyft to get competitive with Uber, because then it would require people to install a new app on their phone that they didn't want to install. Yep. So the same thing is going to be happening here with crypto and with Hex specifically, because with that one, as more people pile into it, that creates more reflexivity, that creates more FOMO, and that more people hear about it then. It's that whole network effect thing going on. Yep. Yeah. All right. I see a whole bunch of you in the chat right here. If anybody got any questions, now's the time here for them. Tam. Yeah, what you got to say here, Tibbet? Cairo, you're so smart. Oh, I'm blushing. I appreciate you teaching me so much. Yeah, I appreciate you, Tam. You're my number one cheerleader out of all this. Table Ruse, this channel is basically like having a free university econ class that has a pulse chain added bonus, and it's free. Yes. I'd like to take an econ class from Lamont Black. I don't know if he's still around, if he's still teaching. I'd love to take his class right there. Hey, anybody in the chat here? Anybody in the chat that's a hater? I want to hear from you. Any haters in the chat? Tablarus, to see you had another question. He said, in the future, could those entities with billions in stables, could they get higher secure yield on something like Pulse X stable farming rather than 4.5% from T-bills? Well, here's the thing there, Tablarus, is the deal with that is that the stable coins have to buy treasuries because the Genius Act said they have to do it. So yeah, they probably would. Like Tether would probably rather buy something like a yield farm or some other kind of staking protocol than buy a treasury. But the Genius Act says they have to buy what's called a cash equivalent, and a treasury bill is a cash equivalent, so they don't get much choice. Hub asks, E-Hex or P-Hex? I don't have a dog in that fight because I'm rooting for all of it. And this is what I say about all of crypto in general. Like, even though like the majority of the streams that I do are about the Richard Hart tokens, I'm actually rooting for all of crypto because I think that if all of crypto goes up, that's good for everyone in crypto. That's good for all the coins. I do not root for any coin to fail. It really pisses me off when I see people that are rooting for coins to fail, particularly Richard Hart coins. People are legitimately rooting for it to fail. Like our haters, the Hex haters, you know what they're doing? Like they're so committed to Hex's failure, they're actually still reporting that the SEC case hasn't been dismissed. They're still reporting that it's still going on. Oh yeah, the SEC is still going after Hex. They're still going after Richard Hart. They're going to get them. No, we got dismissed and dismissed with prejudice. So we are the most regulatory clear coin out there. But our haters are still out there lying. So a lot of people think, well, if we send out some marketing and the haters get it, well, then the haters are going to get onto X and they're going to complain. And that complaining is going to be free marketing. So there we have compounding marketing. No, guys, that's not going to happen because the haters lie. You can't rely on the haters to be your marketing. You know what you can rely on to be the marketing? I'll show you what we can, and it's all the marketing that we need. That's this. Green. Or, let's see. Let's look at the bubbles here. I think the bubbles look better. Oops. Especially like when we're on some of the other mainstream crypto sites, and our bubbles are like the biggest bubbles of them all. I mean, these ones here that we're saying, this is the last 24 hours, which hasn't been great for crypto in general because of what? The dollar index. Oh, the dollar index. That's that thing that Cairo keeps talking about, and he says it's super relevant. And a lot of people, they try to challenge him on it, and they say that it isn't relevant. But, oh, man, today really proves that Cairo's right. Yeah. Yes, it does. But this is the best marketing that we need right here, where for the month, almost everything is up triple digits. Only thing I didn't is ink, but that's because ink has the highest price out of everything, so it takes a lot more energy to get it moving. I think ink is going to have a super parabolic top coming up this cycle. I don't want to make predictions on the coins on the Pulse Chain Network. I made a prediction on EHEX. I said, yeah, if Ethereum goes to 20,000, EHEX can go to $7. Because I know that Ethereum is going to get like a huge push from all of the institutions and from all of the retail FOMO. And that is going to help out Hex. That is going to help out EHEX. I haven't made any predictions here about Pulse Chain itself, such as these 4 coins, the 4 core coins. And the reason why is just because I don't want to kind of box myself in here on this. I don't know what could happen with Pulse Chain itself because of all the gatekeeping that it's currently facing. Like if some gatekeeping comes off, then oh my goodness, man, we could see astronomical returns that you didn't even think were possible. Like, I mean, the stuff you'd be seeing on this screen right now under the 24-hour chart, even you would see numbers here that are triple digit, maybe even quadruple digit. You wouldn't even believe it's possible. I don't want to say that though. I don't want to say that. I don't want to predict it or anything and have people get their hopes up on Pulse Chain itself. I will make a prediction on EHEX there. If Ethereum does 20,000, then EHEX can do $7. But here's the deal. If you like EHEX, you'll love Pulse Chain Hex, because Pulse Chain Hex is the exact same code on a chain that was built for Hex. All right. Tablarus, go ahead and type in your question there. Crypto GPA says only 10 million purchase in Hex would do $1. Oh, what do you think about the Pulse X ratio? Asks HubHub. I don't pay too much attention to it. I don't pay too much attention to that. I mean, I think that both of these assets are going to move up together here just because of Hart's Law. Eventually, Pulse X will surpass Pulse Chain because of the buy and burn. But then Pulse Chain can always, it can have more burned than produced and come back from that. But I don't pay too much attention to it because I know they're going to move up together here. And as long as like your entry point into each one of them was a good price, then it doesn't really matter. And I'm not trading this stuff here. I don't trade. All right, I buy and I hold and I DCA. I'm not selling until the price hits the target I want it to hit. I don't necessarily have price targets here with the Richard Hart Pulse Chain assets yet. Taldarus, your question is, what was it you said about them getting their principal back after 10 years? Is it a specific rule? Now, here's exactly what it is here. Let me show you a bond. When you buy a 10-year treasury, what you do is you're going to give about $1,000 per treasury bond. Or actually, in this case, the official name is a note. Not quite 1,000 here. You see, like this, where it says the price. Here's a trick right here. Like, you want to sound real smart. You want to sound real smart at a party. You want to really impress a girl and get laid at that party right here. Just talking to her about bonds. Yeah. I mean, maybe at first, like, she's kinky. She thinks you're talking about bondage. But man, when you start talking about bonds, Oh, you're gonna really impress the. You're gonna really clean up with the women right there, man. You're gonna really get them turned on. You're gonna add a whole bunch of. You're gonna add a whole bunch of liquidity to their panties when you start talking about bonds. So I'm gonna help you get laid here. What you do is you say, yeah, over here on the ask side, there's a bid and an ask. Well, when you're buying, you pay the ask price because you pay out the ask, and also the quote here, this is a percentage actually. It says 99 spot 012. Spot is bond talk. You want to sound real smart at a party? Just say that when you quote a bond. I mean, I don't know why you'd quote a bond at a party, but you want to sound real smart. That's what you do. You say 99 spot 012. All right. That means 99.012% of $1,000 is what the price of this is. So $990.12. You pay that now. And then in 10 years, you get $1,000 back. Because you notice here, it says maturity date 5/15/2035. That's not quite 10 years, but it's close. So on March 15th, 2035, if you bought this bond, the bond ends on that day, and you get back $1,000 plus the final interest payment. Buying a bond, you loan money. So you lend the United States government $1,000 roughly. You get paid 4.25% in interest each year for the next 10 years, and then at the end of the 10 years, May 15th, 2035, the bond ends. They give you back your principal plus the final interest payment, and then you do what you want with the money, or you go find another bond. That's how it works there. I say you get your principal back. Do you think RH will pump us with the sack bag? If Ethereum has a really crazy run, I think I don't see a reason for him to keep hodling. All right, that's assuming he controls the sack bag. I mean, I don't want to make that assumption, but whoever controls the sack bag, if Ethereum has a crazy run and goes up to 20,000, I don't see a benefit in hodling it beyond that. I mean, some people think that like the Ethereum top is 10,000 or 15,000. Why would you hodl it and round trip that bag? And also, if Ethereum is 15,000, EHEX is going to be like $3, and it's getting a lot of positive attention. So wouldn't you want to sell some of the Ethereum and then direct that money into Pulse Chain so that Pulse Chain gets a lot of positive attention and reward the people who believed in your chain? Man, sure, you want to reward the people who believed in your first project, EHEX, but then if you have the opportunity to also reward the people who believed in your new creation, why not? As I think it's possible, could happen. It just depends on how high Ethereum goes. Because if Ethereum has like a really sad, sorry, piss poor run, I don't know if he'd want to do that. How will the money flow into the alts? Asks BS89. Well, a couple of things here. Like as far as why is what you're asking is like, why does it go into alts instead of Bitcoin? I mean, the first thing here is like, how it flows into the alts is that when they believe Bitcoin has topped out, or they believe that it's too late, like when the Bitcoin price is too high, new people entering the ecosystem go into the alts. And then also it's a matter of like, not just new people retail, but new people institutions. Franklin Templeton doesn't want to be exit liquidity for BlackRock. They don't want to miss out on the crypto run. They don't want to be the exit liquidity for another institution. There you got like some institutional warfare going on if that happens. Like maybe Vanguard would be our exit liquidity because they've been like the most late adopter of them all. So how does it go into alts? And that's worth like a whole nother program, like a whole nother show. Maybe I could talk about that next week as far as like what is the mechanics that causes money to flow from Bitcoin to alts. A lot of it is like there's profit taken on Bitcoin. Some of that profit is taken and shoved into a stable coin like USDC. That USDC doesn't just stay there. It usually goes into some kind of DeFi protocol or a staking program or a lending program, or it goes into a liquidity pool. And just using these DeFi protocols pushes the price of alts up. because to use these DeFi protocols, you got to buy the L1 to do it. And if he hub, and if he does, how much? I don't know how much he would put from like Ethereum into, or from the SAC wallet into Pulse Chain, because it all depends on what Ethereum does. Not surprised they didn't drop rates yesterday, but what about September? Yeah, we looked at that here. I don't think that's going to happen in September either, because look at this. According to the Mercantile Exchange, they've now flipped. Chicago Mercantile Exchange and the betting that they do on the Federal Reserve's direction and interest rates that they take on the meeting, it was 60% believe they would cut in September. Now 60% believes they will not cut in September. And as we go further out here, October doesn't really look that great. I mean, yeah, they think there'll be a cut in October, but not by much, only by about 5% of the people. And then December, it's kind of the same thing. They think, well, if there's going to be a cut, there's not that many. And also like anything that's 2 meetings out, you can throw those predictions away because it's just too early to tell. Especially something at the end of the year. There ain't no way we can predict that. But if I had to make a prediction, I'd say may not be any rate cut at all till Jerome Powell gets replaced. So that means that the bull run could be delayed all the way up until May of next year, or until they name the new guy. I don't think they would name the new guy until it was like really close to the end of Powell's term, because in that case, then what that does is that says, hey, don't pay attention at all to the Federal Reserve chairman. Just pay attention to the White House, because what we say goes. And that could cause a lot of chaos later on down the road. So I don't think we get a rate cut in September. I don't think we get a rate cut at all till next year. And the only thing that can really get the crypto market pumping this year is if we have quantitative easing start this year. They start buying up the treasuries at the Federal Reserve, or the banks start buying up the treasuries at the Federal Reserve. And I'm not complaining about it. I think it's a good thing. I think it's a really good thing here that we have more time to accumulate more of these coins and make asymmetric purchases. All right. The Fox Mulder is echoing my sentiments there. BS89. Does that mean when BTC rips that alts get stuck in a range until it has topped out? Not so sure what you mean there, BS89. I guess what you're saying is like when Bitcoin rips, alts get stuck in a range until it is topped out. Oh, you mean like do the altcoins, do they kind of like stay bouncing back and forth, kind of oscillating in between 2 points here, like there's a support and resistance until Bitcoin tops out? Not necessarily. I mean, that hasn't always been the case here in previous bull cycles, because like a lot of people are front running in the sense of like, hey, I'm too late for Bitcoin, but I'm still early for altcoins, so I'll buy the altcoins, and that pushes them up. And it's still, even with though Bitcoin's its own separate thing, and it leads the market, still what you see is it drags the alts up with it. Because like last cycle, when Bitcoin had its first top in May, it brought Ethereum up with it and the alts. And then when it did it again in November, it brought Ethereum up as well. It's just that the alt season lasted another month after that. What do you think of the current state of the Hex Pulse community? I think we're more positive now that we see some green candles. Who would have thought that, hey, everybody making money makes people happier? And yeah, I mean, we got most of the jerks out. We got 2 of the biggest jerks out of it. Or we don't really see them that often. They're not rearing their heads and spreading as much negativity as they used to. I don't know if there's more jerks that we need to kick out of here. But, hey, I keep putting out the open invitation that, hey, if you're a bear and you think I'm just dead wrong, let's get on a live stream. We'll do it on RH Max's channel so that we have a fair moderator, and I'll even go on mute while you're speaking so that you're not being so you don't think I'm just here to have a shouting match with you. Nobody's taking me up on that. Nobody's taking me up on it. What do you see going up first, E-Hex or P-Hex? I see E-Hex going up first because, like, Ethereum would probably get the first rotation after the Bitcoin top. That's like the first thing to go up in alt season is Ethereum, I think. And that's how you know alt season really hasn't started because we haven't even surpassed the previous Ethereum top. And I'll tell you, like that whole that Ethereum season probably ain't going to start going until the Ethereum staking ETF starts trading because that's going to have a real big hand in it, I think. And when Ethereum is blasting off, of course, it's going to drag up all the ERC20s with it. You're going to see EHEX go up. A lot of the GameFi tokens. I really like the GameFi tokens up on Ethereum. I'd buy up a bunch of those too if you're looking for something else to buy because there's a lot of what I call the penny coins in that. Go over that concept with you guys one more time here, and then we'll call it a stream. What I mean by penny coins. Hey, where'd I put it? Did I? I'll just share the entire screen here. All right. What I mean by penny coins is coins that cost less than $1 for each unit. Hey, look at that. All of the pulse chain assets are not just less than $1, they're less than a penny. Root Network, this is an ERC20 that you can buy for less than a penny. Gala, that's also a gaming token like the Root Network, which is an ERC20, and when you buy it, you'll get a bunch of them right here, almost about 100 of them. Well, less than 100 because it's at 1.5 cents. Caspa's another penny coin. The graph's an ERC20. Caspa's not. Pith is on the Solana network. Another penny coin. I like penny coins because I get to make what I call asymmetric purchases. That just means that I put $1 into it, but I get more than one coin for it. That allows me to accumulate a lot of these coins all at once and in large quantities very quickly. And then when the asymmetric returns happen, they can happen a lot faster and they can have a much more exponential impact on the overall portfolio. And that's the real reason why I like Hex and Pulse Chain. All right? It actually has nothing to do with Richard Hart. Like if Richard Hart died, I don't want him to die, but if he did, I'd still be investing in these. I don't give a damn if he ever streams ever again. Because the thing I like about them is that I can make asymmetric purchases with them right now. And with the liquidity that they have, the low liquidity they have, they can make asymmetric returns. So all these people are just like, Richard's not going to stream ever again. So the prices are never going to go up. I think that those people are stupid because that's not a reason to invest in these coins. In fact, like that's what this stuff was invented to get around. It was invented to not have to be, to not have to be relying on a middleman, for God's sakes. It's another thing to complain about later, though. Maybe another stream. All right, Hub, you get the last question here. Hard question. Do you think RH should not have made the pulse chain and just let Hex be, as now it's all diluted? No, I don't think he should have not done that, because, like, here's the deal. Ethereum network is going to get clogged up. I mean, it's not that bad now with the fees. It will get bad. It will get real bad when the price of Ethereum goes up and the network usage goes up and it gets clogged. You're going to be looking at paying $5,000 to end an EHEX stake. All right. Now, I know where this question's kind of going here. There's a lot of people think, well, there's more coins now this time around, and that is diluting the new money that comes in and is causing these coins to not be able to go up as much as they can, or as much as they would if there were less coins. That is bullshit. And I'll debate anybody on this right here. I will debate anybody on it. You don't think this is right? I'm going to tell you that. Let's get on a live stream and talk it out here, because I will show you the number of coins out there does not matter. Does not matter at all. If you think that's what's holding the market down, that's bullshit. Absolute bullshit. Because 99% of all the coins that are out there are not available to buy where 99% of all the new money is going to go. Because the majority of the new money is going to go to exchanges like Coinbase, like Gemini, like Kraken, like Binance. Is there 50,000 coins available on Coinbase? No, only like what, 200, 300 coins available. And also, another thing we got to bear in mind here is that on all these different networks and everything, that all these new networks that all these new coins are on, even the degens don't get to trade them because MetaMask might not support those networks. Rabby might not support those networks. I mean, Rabby doesn't even support our network. And they're supposed to support like some obscure chain. I'm going to show you one more thing here, actually. I know I keep saying I'm going to show you one more thing. I really do want to show you this here so you feel better about what you hold. See, it's on DeFi Llama. Oh, yeah, I should share my screen here with you. So, what I'm saying here is that the majority of these new coins that are coming out are not available to buy where the majority of the money is, so they're irrelevant. But this is something that's like really been standing out to me here lately. When we go over to DeFi Llama, and when we look at the DeFi TVL, oh wait, is there a total TVL here on this? I don't think there is. There's not. Okay, so let's do a couple of things here. Let's look at the DEX volume. All right. So DEX volume, Pulse Chain, and Sonic. That's actually my largest bag is Sonic. But Pulse Chain right here is 18th when we're right behind Sonic. Sonic is a super legit chain, and Pulse Chain is right behind it. It's almost just as it's in a position to be perceived as just as legit. 18th in DEX volume. DEXs are used just by us degens here. Why am I pointing that out? Why is this important here? You know, all these imbeciles out there that go, Pulse Chain is a dead chain. Well, look at all this stuff here. Look at all this. These are all the people that are behind us. How far down does this even go? 409. We are 18th out of 409 chains. That means that there are 390 other chains that wish they were as dead as Pulse Chain. So I don't want to hear any of this horse shit that Pulse Chain's a dead chain when there are 390 chains behind us. Now that's just DEX volume. What about DeFi TVL? See, is it going to cooperate with me? Probably not. There we go. Okay, DeFi TVL. Where are we? 21. 21. So again, roughly 390 chains are behind us and would love to be as dead as we are. So all these idiots that are telling you, Pulse Chain is dead. You just tell them, okay, yeah, sure, fine. You know what? If we're dead, well, then what are the 390 chains behind us? I mean, are they extra dead? Are they zombies? Are they ghosts? Because to be where we are right now, with interest rates being where they're at, with the DXY being where it's at, with the interest in crypto being where it's at, which is just a fraction of what it can be, we're in a really good place. We're in a really good place. So whenever you hear people say crap like that, here's what I want you to do. Here's what I want you to do. I want you to play this here for them. This is our theme song.
Hey man, just want to let you know that sometimes you gotta shut the fuck up. This current time is just one of those times you gotta shut the fuck up.
That's exactly what you do. Whenever you hear any of that crap of like, oh, Pulse Chain's a dead chain. Oh, we're doing just fine. And there are plenty of people out there that envy us right here. And they're going to be a lot more envious. If we're at 20 already here, imagine how much better it's going to be if like a little bit of the gatekeeping comes down, or if a little bit of the SAX funds get deployed into it, or if just eHex does well and people are just like, oh man, that whole Richard Hart thing, I don't think I'm going to give him a second chance. I heard a whole bunch of trash about him, but man, his coin's doing well, and man, I don't want to miss out on any money. That's what's going to happen. So until then, what you say to them is, shut the FUD up. Cairo out.